Hi everyone, my name is Mike Roberts and I am the Head of Strategy and Research for your financial wellness. Just quickly, a bit of background to give myself a little bit of credibility. I've been around for a while, as you can see by the grey hair, so I've spent about 30 years actually analysing, I've actually also not just analysing, but actually collecting and analysing data, demographic data for the use of by financial institutions throughout Australia. I was Westpac's first demographer and I ended up being the chief analyst for probably most of the second tier banks and mutual sector for about 15 years. So I've collected a lot of data over the years, and unfortunately during that time, the data wasn't as useful as it could be. I always really wanted to understand really how the customers thought and what they were thinking. And now that we've got Your Financial Wellness, we do have the opportunity now to get information and data that is pretty unique and is going to be quite exciting in the next few years as we go into a new banking environment. So what's our vision? It's to improve financial wellness in Australia. Pretty high level statement. We developed a financial literacy platform, which is designed to improve the financial wellness of everyday Australians. Now, first thing I really need to do is to say what is financial wellness, and it's probably easy by saying I'll tell you what it's not, and it's certainly not directly linked to wealth. So being financial wellness is just not being rich and having lots of money, but genuinely it's about having enough money to make day-to-day needs. We all need that. And secondly, having enough money to make progress on meeting your financial goals and aspirations. Now, the platform itself also prompts people to actually articulate their goals and aspirations, and you'd be very surprised about how many people, when asked what their goals are, they really don't know. They can't articulate them. So in Your Financial Wellness, we have 20 goals that have been previously picked, and it covers all angles. And that's very important. And I'd like to state there a personal thing of mine, is that not many people actually know what is possible in financial services or what your goals can be. And I don't think I'm a silly, uneducated person, but when I left university, I had absolutely no idea that I had the potential to own a house. None, zero. I come from a background that just no one ever owned a home, and to me only rich people even thought about buying homes. And I'm not alone, because I know, and I read a story one day, that Gladys Berejiklian also didn't think that she could own a home when she left high school and started university. So you can see there that financial wellness and goals can be very different for varied people just based on your background. Okay, so I hope this, now it's important also to access this type of material, we believe, via a financial institution. And I'll talk more about that later. So now we'll just keep moving along. So obviously to talk about financial wellness, we've got to be able to measure it. So to improve wellness, of course, yeah, you've got to establish a measure. So what we did, we partnered with the University of New South Wales in Sydney, the Centre of Social Impact department there at the university, and met a few very clever, smart people, know more about stats than I do, and they developed a 9-question survey that has now been tested and validated in the Australian context to ensure that what the questions are actually do relate genuinely to financial wellness, and have been validated now based on other surveys that have been taken out around the world. So that gives our index and the measure a lot of credibility. Also, just giving a bit of a plug, I guess, for the people who have supported us to date, but we have delivered this research based on the customers of 9 financial institutions, and you'll see them there up on the screen. One of them is actually a superannuation fund, and all of these institutions believe that financial literacy is actually the responsibility of caring financial institutions. It's going to be the new way of differentiating financial institutions from one another, not just on price. And when it comes to open banking, I think price competition is going to become very, very strong, because it's going to be out there for everybody to see. So this is a unique opportunity to actually slightly differentiate and start to think more about your customers and having a deeper relationship with them. Now, also, I would say before we start that we have done some analysis of the people who have used your financial wellness and had a look at what their relationship is with each of these institutions and whether it's improved or not. And on average, we're seeing at least double the increase in the growth of deposits and loans or other relationship measures of the customers using your financial wellness with the institution. So, you know, it is improving the relationship twice as fast as an average member. And just quickly before I get into the findings about the data, I did say before it's pretty exciting. We're not just, I've spent 30 years looking at what people do with their financial institutions, but no one ever really bothered to ask them what their goals and aspirations were, didn't collect too much on socio-demographics, and certainly we never understood their financial wellness index. Also, we collect via the platform expenditure, income, assets, and household debt. These are not just those figures with the financial institution that they may be with, but it encompasses all of their assets and liabilities, etc., across all institutions. And I think that's very important and certainly gives us a full picture of customers. So let's get into it. Key finding, number one, not earth-shattering, but it is very useful, and that is that based on the questions that were sent out, we found that 47% have reported some level of financial worry. 47%, it's nearly half of Australians at some stage worry about their finances. And we've got there a figure of about 21%, just over 1 in 5 people report that they cannot even afford to eat out or go to the movies. So that's probably quite a concern. When we talk about overwhelming stress, we have a way of measuring that, and we found that overwhelming stress was reported by 27% of our respondents, and that came in exactly as the amount that the Centre for Social Impact, the University of New South Wales, were looking for. So they said, yep, that figure is pretty much what other reputable sources say is the level of overwhelming stress. On the other side of the coin, 20% of us are really fully satisfied. So fully satisfied, 20%, that means 80% of us are not. So I guess that means, you know, it doesn't matter how much you've got, yours or a little bit more, but 20% of people are fully satisfied. So 80% of your customers will need to be doing something to improve their current situation. The key variables that underpin wellness, here we're going to talk about each of these in this short presentation. Gender, which is probably the most interesting one. Age, occupation, income, housing we'll talk about, relationship status, and obviously savings and debt and the levels of that do have an impact, but maybe slightly differently to what you think. And the last one, which is very important, is actually financial literacy itself has an impact on your financial wellness. So the first one, and this is one that sort of grabs the headlines, I guess, and we do have someone on our advisory board that talks on female issues at the UN, so she's quite excited about all of this. And that is that we found that there is a very quite a outstanding difference between gender. So females have an average score of 6.1 on the wellness scale and males 6.9. So that is quite a significant difference. Now, I could just talk all day about what we think the factors are here, but I'll just give one simple one. When we drill down, females have just over half of the average superannuation balance than males. Now we can go into all the reasons for that as well. And also, when you look at the stress levels, females are at 29%. And males are only at 19%. So, you know, I guess everybody that's listening to this, their mind's spinning and thinking of many of the reasons why these may vary. So this will probably form the basis of more research as we go forward. But just the fact that there is a significant difference, that's certainly something that financial institutions and even the government should be starting to understand more and trying to address. Age, and now when you think of age, okay, yep, age has got an impact on financial wellness, and it does, but not what I expected. So if you look at the top two segments there. So you can see the 20 to 29 and 30 to 49, it goes from 5.9 to 6. But as the University of New South Wales pointed out, that is not a statistical significantly different number. So you could almost say between the age of 20 and 49, that the average financial wellness score basically doesn't move. So that's quite interesting. So up until the age of 50, on average, we have as many winners and losers. We start off and end up at about the same number. Where it changes, according to our research, is once you hit about the age of 50, suddenly that financial wellness improves. And certainly by the time you get to retirement age, most people have a reasonably solid financial wellness score. And I guess that's pleasing to see as a nation, that, you know, we finally get there, but certainly up to the age of 50, not much changes, and won't go into the reasons why we think this may be happening, but certainly at the age of 50, people are leaving, you know, your children are leaving home, etc. And things do, for the average person anyway, tend to appear to improve over time. Income and occupation. I did say before that financial wellness was not wealth. It certainly does have a strong correlation with income, and that's no surprise. The more income you've got, the more opportunities you've got. But the point I want to make here is on the left-hand side there, you can see that we've got 4 different income levels. And certainly if a household's earning less than $50,000 in income, 48% of people are sort of stressed. But what you do notice is for income over $120,000, it's still 11%. So 11% of households earning a reasonably solid income are still stressed. And what that's telling us is that at the end of the day, income is not the be all and end all. There are other factors in there that can still generate stress. And of course, you know, we all know about the keeping up with the Joneses. So if you live in a wealthy suburb, you're probably paying more on the mortgage. You might be under more pressure to send your children to a private school, etc., etc. Even when you're down the local boat ramp, you're launching your little boat, you're probably looking at the bloke with the bigger boat, etc. So, you know, it is not just about wealth. It's about living within your means more than about outright wealth. And on the right-hand side there, you'll just see a little table that just looks at the type of income that you might be getting. And you can see there, it's pretty obvious. Unemployed people will be far more stressed than other people. Got a much lower wellness score. It's well below 5. And 5, by the way, a score of 5 is seen as you're being stressed as well. It correlates very, very strongly with stress once you're below 5. And note there that home duties, which is not unemployed people, but people that are, you know, caring for people at home or looking after the kids. Now, in today's society, you probably don't necessarily think that they are female, but there would certainly be a bias towards that. And so therefore, you know, that's something that we need to address as well. There's lots of people doing unpaid work, and their financial wellness at the moment is probably not where it should be. Now, this is probably, for me anyway, the most useful and I wouldn't say it's the most surprising, but it's certainly the most useful stat. And that is this thing about trying to attain home ownership housing. I can assure you the Australian dream of owning your own home is very much alive and well in Australia, very much so. So if you look at the ladder here, which is the ladder to home ownership, you start off renting. So on the bottom right-hand side there, we've got a guy, an average renter, and they score about 5.1. So that's pretty much on the stress level. Now, obviously, we don't all own a house get a mortgage on day one. So there is that early period when you're renting, but generally renters are not in a happy place. They're in around that stress level. It jumps very quickly when people start looking for a home and they've saved enough money to get a home. It jumps significantly, 6.7, way above average. Obviously looking forward to owning a home, think we can afford one, let's go. So 6.7 is good. And then sadly, the average score drops, and this is due to that, obviously, to having a mortgage. Now, some people will not be stressed, but on average, people are, and this is probably the ones that would be with the ones that have probably, you know, over geared on their borrowing, etc., or maybe have changed some circumstances. So, you know, people need to be helped and managed through that mortgage era and not to take on too much debt, etc. And we'd like to really drill into why that 6.7 falls to 6.3. The good news, though, is at the end of the day, when a person does own their own home outright, hallelujah, the score just goes to 7.9. And it's very, very obvious that once, you know, owning my own home certainly gives people lots of comfort and security. And, you know, it is the great Australian dream. And that comes out very strongly. Now, relationship status, we can have a few jokes here about, you know, being married, not being married. Being married, on average, tends to be a good thing. Is that because you've got two incomes or whatever? But the average score is certainly higher than if you're not. The one that we probably should be looking at there is the 5.5, and that's people who go through divorce. And unfortunately, it's not as rare as it used to be. So there's a lot of stress. Financial stress. I mean, I'm sure there's other stress as well, but there's a lot of financial stress of people that do go through that stage of life, and therefore that's a sure sign that people need some help as they go through that. They may come out the other end eventually, you know, even financially better than what they went in. But going through that period, it's telling me that financial institutions maybe have a role there to help people through that period. Savings, obviously, savings do correlate with financial wellness, and you can see there if a person's got no savings, they are stressed, as you would expect. And if they've got 6 months' salary, well, they're scoring an 8.1, so they're really, you know, quite happy. But the thing to note here is we're trying to find a pinch point, and we think we found one. So if you look at the second figure there of 5.6, where there's less than 1 month's salary, 5.6 isn't far over the being stressed level, but suddenly it jumps up to almost 6.9 between less than a month and having 1 month's salary. So 1 to 2 months salary, suddenly people are comfortable. So this is a little stat that suggests that once a person has 1 month's worth of their own salary in savings, that seems to make them far more comfortable than if they don't. What's worrying, as you'll see on the bottom there, is that 40% of those that responded don't have a month's salary in savings. Now, debt, again, very obviously, debt does relate to financial wellness, but it's a little bit more complicated than we first thought. Now, keep it simple to start with. If you're struggling to repay your debt, yeah, that's the lowest score we can find, right? Struggling to repay debts, and people are stressed. And even if you're just managing, you're not so stressed, but you're still stressed. So we know that the ability to repay is definitely something that creates stress. And just to note there too, 88% of our respondents had some form of debt, and 30% of those said we're expressing some level of concern at meeting those repayments. So obviously meeting repayments is an issue. I don't think that's any news to financial institutions, and hopefully most of them do the right thing in helping people through that process and not getting to the stage where they can't meet their payments, at least based on, you know, like using a job or something like that. Now, I said it was a little bit more complicated. Debt to income ratio is interesting because I thought that the more debt you had compared to your income, you'd feel less comfortable, but that's not the case. And when I first looked at this, it threw me. So if you have a look there at the second column, it says that debt is less than income. So in other words, you've got a debt that isn't even as high as your income, but they have the lowest wellness score. It's like, and then it clicked. The smaller debts are personal debts. They're personal loans. They're not asset backed. They're loans for things maybe, you know, like cars, or they're not asset generating. And also they would tend to be people on lower incomes getting loans for things other than mortgages. So when we talk about loan stress, we shouldn't just focus on mortgages and overcommitments. We need to look at those smaller loans, because people with smaller debts tend to be the most stressed, which surprised me. There is, however, a relationship between debts and financial wellness, and whether or not that debt can be covered by the asset. And you can see there that as the proportion of debt to asset increases, your wellness goes down. So what people do, they get stressed not on absolute debt. They are also really taking into account the value of the asset that they bought. And if that asset is obviously increasing in value compared to the debt, then they're less stressed. And so it could be a good idea to point out that when you do get a mortgage, the mortgage mightn't be going down so much, but the value of your asset going up, and then for people go, oh, great, and they feel a little bit better. So that's what we get out of that table there. And finally, and this is really important, especially for your financial wellness, is financial literacy itself has a very strong correlation with financial wellness. So what we did, we had 3 questions which are put on our platform, and they're quite basic questions, I guess. I mean, some people find them harder than others based on the results. So there were 3. Those that didn't get any correct, on average, scored 4.9, which is stressed. If you got 1 out of 3, you got to 5.8, which is reasonable, but still not average. 2 correct is about average. But if they got 3 correct, their financial wellness is quite high. It's 7.2. So it's showing that just being financially literate, obviously you're knowing more, you're making the right decisions, and that's leading to an improvement in financial wellness. So that really bodes well for the fact that we should be delivering financial literacy to customers, because at the end of the day, the more they know, the better decisions they make, and their financial wellness will actually improve. I'll just very quickly mention the financial goals. It is important to know your goals. Most people don't even know what a financial goal would be. I've just listed there the top 6. It is interesting to note, and very pertinent. This is actually very interesting for super funds. Is boosting retirement savings is the #1 goal. Nearly everybody wants to do that. Okay, so we want to be able to retire with money. Now, obviously, that goal increases as a person ages. So for over 45, nearly everybody says that. Obviously, if you're in your 20s and 30s, you're dropping back down there to buying a home and repaying the mortgage, etc. They are very, very important goals, and they certainly lead to the greatest financial wellness if achieved. The one that is interesting is the good old saving for a holiday, and I was expecting that to be in the pre-retirees or just retirees, and it's actually in 30 to 34 year age group. They love going on holidays. I'm going to say too much. I'm a baby boomer, and I've got two 30-year-old sons, and they've probably been around the world more times than I have. So interestingly, people in today's society, when they can, do like to go on their holidays. So remember that. Obviously, when it gets back down to 20 to 29, they're actually into buying a home, repaying the mortgage, mid-30s to 40s. And by the time people hit 45, they're generally thinking more about retirement, although many of them have not repaid their mortgage. And even at age 65, many people have not repaid the mortgage, but are starting to come into maybe some money and they can access super, etc. So I guess that's just a quick overview of how people are thinking and what they're doing. So in conclusion, and I apologise, I had a lot to do and not much time, but the conclusions are, #1, there is a significant gap in financial wellness in Australia. As wonderful as Australia is, and the great dream is alive and well, and most people get there, there are big gaps in financial wellness throughout Australia, and we did see the gender one probably being the most topical. That gap is driven it's driven by a complex mix of socioeconomic variables, as we've seen. And the final point we'd like to make, because we believe in Australia, this is probably where we're heading, and that is financial wellness. It's not taught in school. We've got now the Barefoot Investor making millions of dollars out of writing books about it. And I recommend everybody buy that book. It's fantastic. I read it in about 2 hours. I couldn't put it down. It's really good. But it should be the responsibility of caring financial institutions. And we believe in the future that financial institutions will move more and more towards realising that their role is not to sell your home loan, it's actually to ensure that you have a home. It's more about understanding who you are, understanding what your goals and aspirations are, and and then partnering with you to be able to achieve those through the products, obviously, that they have. And thank you for your time. I think that's my time's up. I know there's a panel coming up that will discuss some of the things that I've had to skip pretty quickly in a little bit more detail. And I thank RFI for the opportunity and anyone that's listening for their time. Thank you.